At first, this looks like the greatest success story of the 21st century. A city that turns dust into gold, and skepticism into a global playground for the ultra-wealthy. We see the headlines about record-breaking property sales and the sheer volume of capital moving through the Emirates. But what most people do not realize is that the very foundation of this growth is undergoing a violent, unseen transformation. This might not be what it seems. While the world watches the lights of the Burj Khalifa, the people who actually move the gears of the global economy are starting to notice a subtle crack in the glass. It starts with a simple observation. Why is it that at the same time the city claims to be at its peak, some of the most ambitious projects in human history have quietly fallen silent? To understand the scale of the illusion, you have to look past the marketing and into the data that the brochures won't show you. Behind the scenes, the signatures on 9-figure deals are being delayed, not by weeks, but by months. In the first quarter of 2024, we saw a massive surge in luxury transactions, yet the secondary market is beginning to show a different, more chilling pattern. There is a dual perspective at play here. One side sees an unstoppable powerhouse, but the other side, the insider side, sees a system that is beginning to cannibalize itself. This is the part nobody talks about. We are told that the world's elite are flocking here for safety, but privately, the conversation is shifting from growth to exit strategies. This is a story of a system that is changing, or perhaps cracking under the weight of its own ambition. By the time we are done, you are going to understand something most people miss. You are going to see the specific moment where the momentum shifted and the billion-dollar illusion began to flicker. Is this a city reaching its final form, or are we watching the world's most expensive waiting room before a massive structural reset? The answer lies in the silence of the projects that were supposed to be the crown jewels of the desert. To be fair, Dubai has defied the critics before, and many will argue that this is just a natural cooling of a red-hot market. But when you look at the behavioral shifts of the people with the most to lose, the data suggests something much more permanent is happening. Behind closed doors, the confidence is no longer absolute. The curiosity gap is widening. If the money is still flowing in, why are the cranes starting to stop? We are going to open that loop right now. This is not just about real estate, it is about the physics of a dream that has outpaced its own reality. Keep that in mind as we look at the first piece of the puzzle, the $12 billion in luxury developments that have suddenly, and without explanation, gone quiet. This is where the story breaks. Behind the glittering data of 250 billion dirhams in first-quarter transactions lies a quieter, more calculated reality. To understand the context, you have to realize that Dubai is currently a city of two speeds. In 2025, developers launched over 150,000 new units, yet by the start of 2026, actual handovers have consistently fallen below those aggressive forecasts. While the press releases celebrate record-breaking sales, the physical landscape tells a story of strategic hesitation. Take the Dubai Creek Tower, once pitched to dwarf the Burj Khalifa. As of early 2026, it has been completely redesigned, shifting from a race for sheer height to a lifestyle-focused monument, a move that signals a massive pivot in how the emirate views its own future. Even the legendary Palm Jebel Ali, dormant for years, is finally seeing infrastructure contracts worth 810 million dirhams, but the timeline for completion has shifted significantly into 2027 and beyond. This isn't just about construction delays, it's about a fundamental reassessment of value. We are seeing a market where price strength is driving growth, with the average residential price hitting nearly 2,000 dirhams per square foot. But the volume of transactions is only growing at a fraction of that rate. This indicates a market that is becoming increasingly top-heavy, fueled by high-value transactions rather than broad-based demand. To be fair, the official narrative is one of stabilization and maturity, and with the population surpassing 4 million, the need for housing is objectively real. However, the disconnect between the massive supply surge of 42,000 units expected this year and the actual delivery constraints suggest that the system is hitting its physical and financial limits. Behind closed doors, the question isn't whether the demand is there, but whether the infrastructure can actually keep up with the ambition. Most people see a skyline in progress, but the smart money is looking at the gap between what was promised and what is actually being handed over. This is the context of a billion-dollar illusion, a city that is forced to redefine its identity even as it tries to maintain the appearance of an unstoppable boom. While foreign investment rose 26% in early 2026, the investors themselves are becoming more selective, focusing on near-completion homes and established communities rather than the speculative dreams of the next decade. The machine is still running, but the fuel is changing, and the stakes for those who are late to the realization couldn't be higher. This is where the math of the desert begins to feel heavy. To understand why the elite are hesitating, we have to look at a familiar situation: a luxury apartment launch in the heart of the city. Usually these sell out in hours, but in the first quarter of 2026, a subtle crack appeared in that narrative. Total transaction volumes across the market fell 18% compared to the end of last year. While the headline price of a villa is up 43% year-on-year, the apartment segment, the massive engine of the Dubai skyline, has seen volumes contract by 25%. This is the first quantitative proof that the fever is breaking. Behavioral shifts are now visible. Buyers are no longer rushing. They're adopting what analysts call a wait-and-watch approach. In March of 2026 alone, deal closures saw a noticeable drop as geopolitical tensions and rising supply levels finally forced a moment of reckoning. The insight here is uncomfortable. The market is moving from a state of momentum to a state of extreme selectivity. We are seeing a dangerous divergence where more than 120,000 units are scheduled for delivery this year, yet industry frameworks suggest only 48% of them are realistically going to be finished. This creates a strange, concerning reality: a city that is oversupplied on paper but under-delivered in reality. The uncomfortable implication is that the dream is being throttled by its own complexity. Privately, developers are offering 7% discounts just to close deals, and extended payment plans are becoming the only way to move off-plan inventory. Behind the closed doors of major firms, the pressure to maintain the illusion of a boom is clashing with the reality of a global cooling. Most people miss the fact that even with record transaction values of 172 billion dirhams, the actual number of people buying is shrinking. It's a market being propped up by a few massive, high-value deals, while the middle is starting to hollow out. This is the part nobody talks about. When the volume dies, the liquidity follows, and in a city built on the promise of fast exits, a lack of liquidity is the ultimate red flag. Something doesn't add up when rental volumes are down 15% while supply is up 24%. This is where the story breaks, because it suggests the people who are supposed to live in these towers aren't arriving as fast as the steel is going up. Smart move or a dangerous mistake? The people holding the keys are starting to wonder if they are early to the future or just wrong about the present. This is the moment where the story shifts from a local real estate trend to a global survival reflex. Up until now, we've looked at the cracks inside Dubai. But as of May 2026, an external shock is forcing the city into an urgent, uncomfortable corner. Regional tensions have suddenly placed a live stress test on the world's most famous supply chains. While the official narrative remains defiant, with authorities doubling down on the D33 agenda, the reality on the ground is becoming increasingly urgent. Shipping routes in the Gulf are under immense pressure, and for a city that imports nearly everything, including the very sand it needs to build its skyscrapers, this is a nightmare scenario. Most people think Dubai is surrounded by sand, but desert sand is too smooth for high-spec concrete. The city actually relies on millions of tons of imported construction-grade aggregate from places as far as Australia. Now, with the Strait of Hormuz facing intermittent closures and shipping costs spiking due to the ongoing conflict between regional powers, the physical cost of building a dream has reached a breaking point. In April 2026, Dubai was forced to approve a 1 billion dirham economic support package just to inject liquidity back into the system through fee deferrals and hotel subsidies. This is the shift in tone. The era of effortless growth has been replaced by a period of strategic defense. Behind closed doors, the conversation has moved from expansion to reprioritization. Industry insiders are privately admitting that input costs for major projects have surged 12 to 15% in just 90 days. This is the escalation. When the global narrative around inflation and interest rates finally met the local reality of a supply shock, the stakes were raised for everyone. If you're an investor holding off-plan property from a secondary developer, you are now facing a terrifying reality. The materials to finish your building might not just be more expensive, they might not be coming at all. To be fair, Dubai's infrastructure is world-class and designed to absorb these shocks. But the pace of real estate development is now being throttled by geopolitical forces that no amount of marketing can fix. The mood has dipped, and the pauses in deal-making are no longer just about caution, they are about survival in a world that has become fundamentally more volatile. This is no longer a slow-motion correction, it is a high-stakes race against a closing window of global stability. Are the developers being resilient, or are they just stalling for time while the costs explode? The decision trap is closing, and the once silent deal rooms are now filled with a new, urgent kind of noise. Zooming out from the construction sites and the shipping lanes, we have to look at the deeper mechanics of the system itself. This is the moment we reveal the engine under the hood, and it's a machine designed to run only at high speeds. In 2026, Dubai's economic model is facing a classic decision trap that most people miss because they are blinded by the luxury. On one hand, the government must keep the supply of mega projects flowing to maintain the City of the Future branding that attracts global capital. If they stop, the perception of growth dies, and in a city built on momentum, that is fatal. But on the other hand, if they continue to pour billions into a market where transaction volumes have already dropped 18%, they risk a massive structural oversupply that could crash prices and wipe out the equity of the very billionaires they are trying to attract. If they build, they risk a bubble. If they stop, they guarantee a stagnation. It is a mathematical stalemate. This is the system-level insight that the smart money is starting to internalize. Dubai is no longer just competing with its own past, it is competing with a new global reality where capital is becoming more expensive and less mobile. Behind the scenes, the sand economy is revealing the fragility of this model. We are seeing a shift where the cost of maintaining the illusion is now rivaling the cost of the actual infrastructure. When you factor in that the Emirates' debt to GDP ratio remains a point of private concern among institutional lenders, the mechanics of the billion-dollar illusion become clear. The system was designed for a world of zero interest rates and infinite global peace. In 2026, neither of those exist. Most people talk about the sand mafia or the supply chain as a temporary hurdle, but the deeper truth is that the resource cost of high-rise urbanization has hit a point of diminishing returns. You are seeing the part nobody talks about. The moment a system becomes too complex to be efficient. Privately, the massive sovereign wealth funds are shifting their focus away from the skyline and toward digital infrastructure and food security. They are diversifying because they know the glass and steel model has reached its limit. This is the part where you see what others don't. The skyline isn't a sign of what's coming, it's a monument to an era of growth that is fundamentally changing. The gears are grinding because the world that Dubai was built for is disappearing. Now, every investor faces the ultimate cognitive tension. Do you stay for the transformation, or do you leave before the crack becomes a break? The mechanics of the desert are shifting, and the exit is getting narrower every day. This brings us to the final, uncomfortable question that every investor in the desert is currently asking themselves behind closed doors. Is what we are witnessing a collapse of a dream, or is it a violent, necessary transformation into something we don't yet recognize? We have seen the silent cranes, the 18% drop in transaction volumes, and the $12 billion in projects that have quietly gone dark. We have seen how the skyrocketing cost of the sand economy is making the very act of building a skyscraper a mathematical nightmare. The data is clear, and the behavioral shifts of the world's elite suggest that the era of blind faith in the Dubai exception is over. So, which is it? Is the system finally facing the gravity of reality? Or is this just the world's most expensive pivot? Are the billionaires who are pausing their signatures being smart by waiting for a bottom? Or are they making a dangerous mistake by betting against a city that has defied every critic for 30 years? The decision trap is now yours to navigate. If you were holding the keys to a $50 million penthouse today, would you still trust the system to hold its value? Or would you be looking for the exit before the flicker in the illusion becomes a total blackout? Most people will keep looking at the lights of the skyline, but now you see the specific, calculated mechanism of the crack. This isn't just a story about a city in the sand. It's a story about what happens when the world's most ambitious project runs out of momentum. And if the momentum is truly gone, then the next chapter isn't about growth, it's about who gets out first. But even as the luxury projects go quiet here, another even more secretive shift is happening just across the border, one that makes the Dubai illusion look like a rehearsal. To understand the full scale of the coming reset, we have to look at what is happening in the one place everyone promised would never change. But that is a story for the next documentary.